Hello, and welcome to Trading Without Fear. In today's episode, we're going to be talking about patterns versus setups.
In today's video, I'm going to talk about the chart patterns and setups you should be looking for.
Many traders, both new and people who have been trading for years, often confuse the two. What is a setup and how is it different from a pattern? All markets are traded by real people, and because the charts we analyze represent the collective minds of the people who are participating, patterns present themselves in the market. These patterns can form in any time frame. One thing I've noticed is that gurus do not explain the difference between a setup and a pattern. This leads to confusion and frustration when learning how to trade. They will often mix them together like they are interchangeable.
In this video, we're going to talk about how do you find a pattern? Like I always, say, look, I make all this money off patterns. How do you actually find them? In this video, I'm going to explain how. I profit more times than not off predictable patterns, dip buying, morning panics on recent supernovas, shorting the first red day on recent pump and dumps, and buying the first green day on ideally a former runner or an OTC with big volume, with big catalyst. These are my three favorite patterns.
I use Tim Sykes as an example because there's a lot of content out there. As examples, we're going to be using the list from Tim Sykes. Dip buying morning panics on recent supernovas or stocks that's been running up multiple days. Shorting the first red day on stocks that's been up multiple days or even weeks. The first green day play. But how many times have you bought a morning panic or shorted the first red day or even bought the first green day only to lose money?
52-week high break on volume. So what that is a chart that has been steadily uptrending for for days and weeks. Now, the next component we're looking for is a gradually uptrending chart and then a high volume breakout.
Tim Bowen just talked about the 52-week high breakout. As you can see from Tim Bowen's example, the chart is on a daily time frame. Would you just buy the breakout? How would you actually trade the Tim's trading ideas? Now what I want to do is break down one of Tim Sykes' favorite stock plays, a morning panic dip buy. According to Tim Sykes, a morning panic is when a stock has had a recent supernova, or in other words, multiple green days in a row. The morning panic dip buy confuses many new traders, which is why I chose it for this example. Tim Sykes says it's one of the best stock plays for a new trader to learn. I have traded it myself early on in my trading career, and for me it was like catching a falling knife. I know that many traders have found success in using this stock play, and I'm not saying you can't as long as you understand the setup and pattern. You don't just want to dip buy any stock. Using DCEN as an example, DCEN was running from March 3rd through April 23rd, 2020. This stock was on a multi-day run. As the stock continues its move higher, there's a high likelihood that dips will be bought up. As selling pressure overwhelmed the buying, a washout occurred. Panic-stricken buyers became sellers. Once the buying overwhelmed the selling, it bounced. People thinking, buy the dip, this is going to the moon, averaged down their positions or added to their positions, while savvy, panicked buyers waited for the turn and sold into the bounce. The answer is no. Using Tim Sykes' morning panic criteria, he buys a morning panic on a stock that has a recent supernova or multiple-day run. A setup is on the daily time frame. Some people refer to this as the big picture. The pattern is on the intraday time frame. In case of a morning panic, the setup is a stock running up multiple days or even weeks. The pattern is this stock having a morning panic at or near the open. You need a repeatable pattern intraday to base a trade on, not just the setup. If you're basing your trade solely on the setup, you'll have more losing trades than winning over a large sample size. One setup is a gap and crap, and the inverse is a gap and crap reversal. They both have the same setup. They both have a gap up on the day, but the intraday trading signal or patterns are vastly different. You will be placing the odds in your favor when you combine a daily setup with an intraday pattern. Using a setup even backed by data can put you through unnecessary losses or even emotional pain. Not all traders trade the same setups or patterns. In order for your data to work, your criteria for both setups and pattern must be predefined. I hope you found this video helpful. If you did, hit that like button and subscribe to the channel, and I'll see you next time.